Welcome back. On today's video, we're talking about student loan repayment. There was a new article that just came out on CNBC, so let's jump right in. This is on CNBC.com. It's part of their Make It series, and it's talking about the student loan repayments really becoming a focus now for the Department of Education. It says the Department of Education will resume involuntary collections, which is their way of saying they're going to collect on this debt by either going to a collection status or worse, and that'll be resumed on May 5th. It's talking about borrowers who have student loans, and the ones that they're currently considering in default are at least 270 days late. Let me blow that up a little bit. So the Department of Education is extremely more flexible than most private debt. And by that I mean usually with a private debt, whether it's a car loan, credit card, or mortgage loan, if you're 60 to 90 days late, they're considering that a default and they're starting proceedings to collect that money from you. With the Department of Education, 270 days is their magic number, which seems to be extremely flexible. Now, there's reasons for that. Of course, a lot of students are just getting out of school and they're going to repayment 6 months after that, so it gives them time to get established, to get a job, to start working on their budget. But no one could anticipate the last 5 years of non-payments being owed and the confusion that has ensued on the political spectrum. This video is not intended to be political at all, so let's kind of keep that out of it. It's talking about here, there's at least 5 million borrowers that are currently in default. So 5 million people are over 270 days past due or missing their first payment on student loans, and another 4 million are in late stage delinquencies, meaning 90 to 180 days late. But the Department of Education is going to be a lot more aggressive now by starting the repayment process and starting collecting on that debt. Here's the bigger concern for me. Borrowers who don't make payments on time will see their credit scores go down, and in some cases their wages automatically garnished. In the past, when I was in the credit and finance world, we would frequently see credit reports that had student loan delinquencies on them. That is absolutely a possibility. You'll see that people have either gone into repayment and stopped paying, or you will see that they just never started paying on their student loans at all. And student loan debt does not go away. With credit card debt, with other loans, if you default, it'll just either go to a collection status, judgment status, and eventually it'll fall off, or people can file bankruptcy on it. On student loans, that's not an option. Once you're into a student loan, you cannot go bankrupt on it and alleviate that debt through the bankruptcy process, and it will not just disappear like some other debt will. That's because the federal government, with all of the other taxpayers, are backing the debt, and they're not going to make it easy to push that debt off onto other people. Because what would happen is if those debts if they're backed by the federal government and thereby all the taxpayers, if a borrower defaults on it, it kind of shifts it and the federal government has to pay it, which means everyone else has to pay it. So they don't make it easy for you to get rid of that debt. Now, here are some of the things they can do. Once you go into a default, wages can be garnished. Tax refunds will be seized, which means you won't get a tax refund. You will still have to file your taxes, but you will not get a refund if there's any money due to you by the federal government. And if you're ever looking to get an FHA loan or a loan that's federally backed for a home, you're going to have trouble doing that because you've defaulted on one federal debt already, and they're not going to be very interested in giving you another loan. If you haven't defaulted already but can't afford the monthly payments, there are several options that the government does offer, and we can hop over to those right now. And we're just going to touch on these briefly. This is something that you would need to look at with your servicer, but the three options are the IBR, the PAYE, and the ICR plans. IBR is income-based replacement. This talks about once you're into an IBR situation, your monthly payment is calculated as 10 to 15% of your discretionary income, and your discretionary income, as we'll show in the article, is after taxes but before all your other voluntary deductions like your retirement account and normal spending. So this is an option for people if they were not able to get a job that paid them enough to make the student loan payments, then they can look into getting an IBR. The income contingent repayment is something where, and this is for direct subsidized, unsubsidized, and consolidated loans, you're able to get a payment of 20% of your discretionary income, or the amount you would pay on a 12-year fixed repayment plan, whichever is less. So that's kind of cool. That's an option. Keep in mind that puts you at minimum of 12 years before you're able to pay off those student loans. But if it's the difference between being able to pay your bills, pay your rent, have groceries or not, this could be a good option. or the pay-as-you-earn loan, or the pay-as-you-earn option for repayment is something that you can look into, where people who have no outstanding balance on direct or FFEL loans, when they receive the loan, they must have received a direct loan, which is a subsidized, unsubsidized, or direct disbursement after October 2011, or a direct consolidated loan based on the application. They can qualify for the pay loan, which is 10% of your discretionary income, which only applies if your income is 150% of the poverty guideline. Your payment on the pay loan cannot be higher than it would be on a 10-year repayment plan. So again, a good option to reduce your payments, but keep in mind, you will be paying for a minimum of 10 years, and it's a minimum of 10 years. Hopping back over into this, options if you are already in default. Enter a repayment agreement. You can call your lender, and they may be able to work with you on a repayment agreement that is less than what your current payments are. You could also rehabilitate your loan, which is basically you start making payments again on a new schedule, and if you make 9 on-time payments to get your loan out of default, your loan can be considered rehabilitated. And it says here your payments could be as low as $5 a month. Now, I haven't looked into that option to see what that requires, but that is an option for people who are looking to get into repayment and to fix a currently defaulted loan. You can consolidate your loans into a direct consolidation loans, pays off all of your existing loans, consolidates them into one. Look at the details on this though, because this was something that was triggered by people who were looking at getting a student loan forgiveness. If they had consolidated their loans, they no longer qualified for a forgiveness. So there are certain parameters around these pieces that you'll need to look at. If you are one of the public employees or public adjacent employees that could qualify for student loan forgiveness, make sure this does not hurt your chances for that forgiveness. And you could also here they've got pay your debt in full, and a lot of people would say, well, gee, that's kind of a silly option, because if I couldn't afford payments, how can I afford to pay it off in full? If you're able to borrow money from a family member who's willing to give it to you at a lower interest rate, that may be an option. Or if you can sell an asset, if you have a car or something that you could sell to be able to pay it off, it may be worth doing that to get yourself out of default and then do something else for transportation, or whatever else it is, or make a valid objections. Now, this is something I don't have any personal experience with. I don't know anyone who does, but it talks about here, if you have reasons that you don't owe the debt, or you aren't behind on payments, or here's the interesting thing, or totally and permanently disabled, you can fill out a form, a request for review, that could make a valid objection to either show that you don't owe the debt, or maybe you're not in default currently. So those are all options that are available to people who are working with their current lender trying to get themselves out of default. These are little options that I hope are helpful to you. The student loan repayment issue has been a source of extreme frustration for a lot of people right now, on both sides of the political spectrum. This video is to help people who are looking to get back into repayment and get themselves out of potential issues that come with being in default. I hope this is helpful to you. If it is, please give us a like down below. If you'd like to see more videos like this, consider subscribing to the channel. And if you know someone this may benefit, do share. Thanks for being here. We'll see you on the next one.